I'm going to talk a little bit about the future of fintech. We're going to cover lots of ground. If you have questions, please use the hashtag, use it on Twitter or in the mobile app and try to get to them. Please ask me easy questions only. If you like something about the presentation, please tweet it out. If you do not like something about the presentation, please just keep it to yourself. So yeah, let me jump in, and we'll go through this pretty quickly, I think. So this is what we do. We take lots of data to try to predict technology trends. You've seen this join the conversation piece. We have lots of great customers, many who are in the room, so thank you. I love you guys a little extra. So this is kind of our mantra, right? Without data, you're just another person with an opinion. So we're going to try to take a pretty data-driven view of what we're seeing in fintech and cover quite a bit of ground here. I think, how many of you are from, I guess what folks will call legacy financial services firms or incumbents? Okay. How many of you like being called legacy financial services firms? Okay. Yeah, that's always... I don't know if incumbent's any better, but I don't know. They both kind of suck in my opinion, but yeah, all right. And how many are startups? Okay, investors? Okay. So we have a pretty good contingent of corporates and investors. So kind of the first part of this is going to just talk a little bit about the sort of pace of disruption, and I hate to use the term because it's overused, but just kind of the pace of advancement when it comes to technology more broadly. Then we'll sort of apply it to what's happening in fintech, talk about some of the areas within fintech that have been hot for the last few years, and then finally end with some of the kind of 9 trends that we're looking at. So when we look out using our data, some of the things that we think are interesting that maybe people aren't talking a lot about today, but they're going to be talking about in the next 12 to 18 months. So if I just go to the next slide. So let's just, first talk about the faster pace of disruption. Who knows what this is? All right, so fear of missing out. So, and this first part is maybe a little bit more oriented towards the corporates or for those of you who prefer to be called legacy. So this is fear of missing out, right? So we find when we work with the corporate clients and they use our data, they use it in one of 2 ways. Some of them are motivated by FOMO, so fear of missing out, and some of them are motivated by this. Anybody know what this one is? So this one is fear of getting screwed. So there's kind of, and these are very different personality types, right? Fear of missing out is sort of an optimistic view of the world. It's technology is going to be big and we want to be out in front of it and use it to enhance our business. Fear of getting screwed is sort of the kind of the scared view of things. So this is a theme that I'm going to try to hit upon a little bit. And, for those of you, again, who are with large corporations, I think it's one thing that's worth thinking about is, what motivates your organization. And we see companies that start as FOGs and eventually move to FOMO, but it's an important driver of kind of how you think about innovation and technology. So I'm going to start with some very basic things, right? So, there's a lot of startups and innovation, and you're going to hear this conversation around unbundling of the bank or of insurance or other verticals a lot over the next few days. So let's just kind of define a few things. So here's Steve Blank talking about, startup is a temporary organization. Eric Ries has, a human institution under kind of conditions of extreme uncertainty. So when you think about it, startups are experiments, right? And so for a lot of big institutional or big legacy financial services clients or firms, they are outsourced R&D, right? And so what you see here is in the last 5 years, the number of early stage financings that have happened within kind of, across sectors. So this is not just fintech. But what happens with these companies that are sort of experiments today is over time they become, and this is sort of the famous Clay Christensen disruption model, over time they become more sophisticated, their performance increases, and, eBay, which started off for Beanie Babies and other things, kind of climbs up and becomes, you can sell art and other things on it. So, this path has been well worn by other folks. And so this is happening more and more. One thing, I see folks taking pictures. You're welcome to do that of the slides. These are all going to be available to you in the mobile app, and we're also going to be sending out all the vignettes as well as these slides. So just a heads up there. This is also the other kind of big seismic shift that we're seeing within sort of the corporate landscape, which is it's sort of harder than ever to stay on top, right? So this is the lifespan of the S&P 500, and you see a pretty dramatic shift down to 12, 13 years now. Your sort of time frame or your time to stay in the S&P. So things are moving very quickly, and the threats really are multiplying. So this is a great slide by the folks at Upfront Ventures, which shows the cost of launching a startup, and it's probably come down even more since 2011. And so what you have now is lots of experiments being created. Technology adoption's quicker than ever. This is an awesome graphic. And so just if you look at the telephone, which is kind of starts in 1900 as that orange line, and you look at how long it took 105 years for it to get to 90% adoption. And then you look at the cell phone, or you look at the internet, right? So look at, the pace at which technology now is adopted is remarkable. And it's something that's important for those of you in the firm, or those of you in the audience who are thinking about how it might impact your business. And even within sort of tech high flyers, the rate of growth is remarkable. So what you're looking at here is, Facebook by any stretch of the imagination was a amazingly fast growing company, and you look at WhatsApp, just kind of blew it out of the water. So, the pace, even amongst the best, has really accelerated. This isn't a tech industry thing, right? So, when you look at the hospitality area, you have Airbnb, and, you can imagine everybody at Marriott and Starwood and everywhere else is talking about Airbnb. And we've done these. We're sort of known for these unbundling graphics. So there's P&G, there's FedEx, there's the hotel, there's the automobile, and then there's of course the bank. So this is Wells Fargo's website, and kind of all of the startups that are sort of taking little slices of it or attacking it on various slices. And it's not just a U.S. thing, right? So this is HSBC, kind of along with some of its European kind of death by 1,000 cuts that are happening. So. This is kind of, I used to work at American Express, and we used to spend a lot of time thinking about Capital One or Visa or MasterCard. And so we were always, looking at basis points, right? Share between one another. And so we, sort of the King Kong versus Godzilla sort of dynamic that we worried about. It's really this death by 1,000 cuts, right? So is it, you have these other folks that are worried, they want to take a comma out of your revenue. They're not looking at basis points, right? So this is kind of this unbundling thing that we talk about. This is what we're talking about when we speak of that. If I just go back to the sort of fear of getting screwed mindset, right? So we hear this a lot. We hear this a lot from financial services incumbents. These are all the reasons why startups will fail, right? They don't have our balance sheet. Our brand is trusted. They don't understand the regulatory environment, whatever it might be. The reality is, most startups fail, right? So if you look at this sort of next slide of, the funnel, right? This is of the number of companies that get seeded, very few come out. So it's sort of intellectually lazy to say that the startup won't work, because most of them don't work. Like, that's the nature of startups. But the reality is, a bunch of them will not work. And so if you look at retail, right? I had the distinct pleasure of working at Cosmo.com, actually. So if you ever ordered Krispy Kreme donuts at 1 a.m. and nothing else, thank you for putting me out of a job. So these are all the companies that didn't work, but the reality is it's the 2 or 3 or the 1 that works that becomes the problem, right? So if you look at CPG companies, you look at Macy's, like they are maybe late to the game, but they're thinking about Amazon in a big way. And so for those of you who are financial services incumbents in the room, there's who is your Amazon, who's your Uber, who is that going to be? And there's going to be lots of casualties, but you can't take solace in the fact that lots of startups die, because it's the one that makes it that becomes the problem. So your sort of organizational mindset determines how you respond to this, right? Are you playing defense or are you playing offense? So kind of that's sort of the high level kind of view of how things are going and sort of how we think organizations should be thinking about this. This is a little bit more of the sort of the state of the union of fintech. So financial services, massive part of the U.S. and global economy. You can see here as a percent of U.S. GDP, kind of just how much it's climbed. So you have a big market, and so investors and startups kind of see that. And what you notice is that financial services firms haven't necessarily kept up to date on technology, on demographic trends, on customer service expectations. And so this is a opportunity for all these companies, right? And so this is, how much of these various industries are kind of internet or not internet enabled. And you can see financial services doesn't look very pretty here. Here you see kind of how mobile and the distribution that it offers lets people, lets upstarts kind of get distribution very quickly, and so this is just private VC-backed apps that are in the top 100. So, again, kind of a change in how things are distributed, how you build a relationship with the customer. Then you have the much talked about millennials, right? And so I won't read all these stats to you, but you have a demographic shift in terms of how people are thinking, and they're thinking differently about finance and their financial services providers. And then the last dimension kind of is on the services side, right? So when you look at the net promoter scores of various sort of financial services firms, they're not, 3, like, it's just, I don't even if you don't know what scale this is on, that's not good. Right, so and at the best, I think it got to 64, which is credit unions, and they are doing very well. And then you look at some of the upstarts, right, and so have much more favorable ratings. And so again, this idea that how do you engage with customers in a different way, and you see some of the new technologies out there that are doing that. So, Jamie Dimon's kind of, along with many bank CEOs, has talked about sort of Silicon Valley is coming. I think this is the only thing I would take exception with here is that it's really not just Silicon Valley. Obviously, the Valley is sort of the epicenter of this, but we're seeing tons of innovation in Asia. And actually, we're seeing a lot of financial services firms here look at what is happening in the Asian investment community because they think those models may eventually emerge here, right? When you have in Asia where you have many areas where there's no bank infrastructure, there's no branch infrastructure, right? How is what they're doing eventually going to come here? Because you think about millennials here who don't want to go to bank branches. So it is, technology is coming. Silicon Valley is obviously a driver, but it is beyond just the Valley. And so kind of banking's Uber moment, right? So this is looking at Netflix and, other folks that disrupted travel, music, and video. Is that going to happen, and what is going to drive that? And that's kind of the big question. This is, Goldman put out a report looking at sort of the lending profit pools that were at risk. And we're looking at massive amounts of money here that are at risk. And that obviously when you see kind of values that large, you have the venture, private equity, hedge fund, et cetera, community that gets interested, and obviously entrepreneurs are interested in that as well. And so we see that in the numbers, right? $34.4 billion has been invested in fintech companies in over 3,000 deals since 2011. And the number is going up, right? And so this is deals in dollars. The blue is the deals. The green is the funding. The more important metric here is deals, right? Because funding, a couple of unicorn rounds can distort that very quickly. Deals is really what's important, right? That shows sort of the buoyancy and vibrancy of the market. And you see that's been climbing, a little bit of a hiccup in Q4 15, but that was kind of broad-based, and it recovered nicely in Q1 16, unlike other areas. You see a little bit of a regional difference. North America, Asia holding strong. Europe is sort of flat, but the numbers are just sort of not impressive, right? Just to be very frank. So we see a level of aggressiveness from US and North American financial services firms as well as Asia-based ones that we don't necessarily see from some of the European incumbents. So the numbers kind of from a financing perspective sort of reflect that. Big financings, it's obviously come down. You see a goose egg for Europe here, but in terms of $50 million financings to the fintech space, kind of have been pretty steady. They've come down, but these are, if you look back on a longer time frame, this is actually, sort of very high versus historical norms. And then for a lot of you in the room, and there's lots of corporate VCs in the room, the amount of corporate participation has climbed pretty significantly. And so we see that, startups have become outsourced innovation for lots of big legacy firms. And so we see that coming up. We see kind of every week, I'd say, a new firm saying, hey, we're thinking about starting an innovation group or a corporate venture unit. So that is evident here in the numbers. This is the big banks and their investments. So this is, in the last, I guess, or sort of subsequent last 5 quarters, Goldman, Citi, et cetera, Santander kind of stepping up. But it's kind of broad-based, not as necessarily as active as some of the people at the top, but you see kind of the list is pretty significant. And this is investment just into fintech companies. So if they're investing in other kind of non-fintech areas, then this is not included in these numbers. It's not all good news, or maybe depending on your perspective. Unicorn birth rate has declined. So this is a public health warning of sorts. So there haven't been any new fintech unicorns in 2016 year to date. So a bit of a headwind. That's not fintech specific. That is financing market has dried up, or has tightened up. I shouldn't say dried up by any stretch, but it's definitely tightened up. Here's the fintech unicorns, by sort of category. So you see payments and lending kind of dominate. That's the blue and the orange. Insurance has been sort of picking up steam, and so that's kind of in the other category, but a lot of those others are from the insurance kind of group. Another obvious kind of headwind is the public performance of some of the fintech companies that have exited and IPO'd. So it's not been pretty. It's On Deck, Lending Club, Square. None of them have done particularly well, right? And so when you see that kind of performance, that obviously doesn't inspire necessarily confidence of investors. And then generally sort of VC-backed fintech exits have been, if I draw a generous trend line, they've sort of gone up a little bit, but it's not a great, picture here from an exit perspective. One of the things that we think is really useful is looking at where the smart money is investing. And so smart money is a handful of firms that we think of as sort of your top decile, so your Sequoias, your Excels, your Greylocks. Where are they putting money? And so when we look at their trend, on the optimistic side, we see them continuing and actually they're at a pace to increase their investments year over year. So fintech remains kind of an active area of investment amongst the smartest investors who have a track record. And where are they investing? So this is a tool on CB Insights called the Social Graph. And so what you see is when we map out the investments of those sort of smart money VCs, a couple themes emerge: real estate, alternative lending, insurance tech, institutional investing tools and data. So, they obviously are investing in more than that, but when we try to pick out some themes using the social graphs, those are some of the common ones that we see amongst the smartest kind of private market investors. So I'm going to take a little bit of a detour, go a little bit deeper now on a few areas that have been talked about, and then we'll end with kind of the trends. And again, Q&A, please put through on the app or on Twitter. So we're going to start with Bitcoin and blockchain. We're going to be talking about this a little bit more later. So this is kind of a high level. Fred Wilson's going to be here talking about his views on it. So the price of Bitcoin is climbed pretty significantly, highest since 2014. This year we crossed $1 billion invested in Bitcoin blockchain startups on a cumulative basis. So a big sort of a marker for that world. But what we see here is that the interest has shifted a bit from Bitcoin to blockchain, and so this is a tool on CB Insights called Trends. So we mine sort of media chatter, and what you're looking at here is sort of the number of media mentions over time of these two things, and we'll dive into a little bit where blockchain is getting interest. So blockchain has lots of applications, and you can actually use this media chatter to see where people are talking about it most. And this was The Economist used some of our data to just sort of prove out not just the media, but the actual investment into Bitcoin and blockchain is going in slightly different directions, as you can see here. Blockchain has become a pretty desirable area amongst the corporates. So you see kind of in the top 5 largest blockchain deals and Bitcoin deals, corporate participation is really ramping up. So it's one of the hottest areas, I'd say, amongst financial services firms, whether it's insurance, banking, payments companies, kind of across the board, folks are very interested in what's going on in blockchain. And then there's sort of incredible diversity. So again, if I just take this snapshot of the social graph, these are all of the different financial services players who've made an investment in blockchain and Bitcoin. And you see, everybody from the payment networks to New York Life on the insurance side to big banks. So it's incredibly diverse. And then obviously folks like Google Ventures are here. So everybody's really sort of clamoring to understand this space and get access to it. Wealth management and personal savings. The robo advisors, we have John Stein here later today. So it's in this. The y-axis here is on a logarithmic scale. So the automated investment services are still a real drop in the bucket relative to these other categories. Expectations are that they're going to grow, to be pretty material by 2020. Investment continues in the space, so you see here's some of the folks that have raised, and here's some of the recent sort of funding announcements for those folks. So it continues to be a hot area. They've both grown, Wealthfront and Betterment kind of are two of the better known sort of robo-advisors on the private side. They've grown their AUM both relatively quickly. Betterment's kind of exceeded Wealthfront recently, so you see that here as well. But it's not all roses. So here's the AUM growth is slowing of both of them. So it's there are headwinds. One of the things that we've seen recently is when market volatility picks up, people want to talk to an advisor. And so how does their model work in that case, right? So when the market's sort of steady and going up, everybody's very happy, right? When things aren't, that's when they want to talk to somebody, and they might just want to be consoled and told that probably don't worry about what happened every day, but people are listening to I don't know, Mad Money or whatever, and so they get spooked. Incumbents have taken action as well, right? So this is, I think, one of the best examples. There's this sort of knowing versus doing gap that we see amongst big incumbents. Is big corporations are amazing at PowerPoint, right? Like they're really good at decks about a space, like amazing decks. I used to make them at American Express. But then the doing part is where it gets harder, right? So how do you, I have all this knowledge, but am I actually going to put some money behind it? Am I going to put a team behind it? Am I actually going to do something about it? Or are we just going to present, all day long and watch somebody else do it? In the case of the robo-advisor space, you actually see Vanguard and Schwab actually did something about it, and very quickly they've kind of seen kind of results, right? They have a brand, they have an institutional, they have a customer base. So again, great example of kind of not just knowing but actually doing something about it. Then you have startups like Acorns. So this is kind of savings rolling into kind of the robo space as an investment. Still early days, but kind of from an AUM comparison perspective, it's still relatively small. But obviously, you see a big number of accounts. So you're looking at very sort of small accounts in general. But again, targeting that millennial base is something that a lot of financial services firms are trying to figure out. And Acorns is an interesting model in that regard. This is kind of, one of the concerns about robo-advisors, or building a standalone robo-advisor by the CEO of Morningstar, basically saying you need a massive asset base to justify being in this business, right? Because it costs a lot to acquire customers. You're making very little per dollar that you manage, so it's a volume game. So that's one of the challenges in the space. And so given the scale requirements of the robo-advisor kind of industry, those that haven't been able to show scale have been gobbled up, right? Relatively small AUM for most of these companies, but maybe there's a technology or a team that folks could pick up, and so you see some of those acquisitions that have happened already in kind of the wealth management space. Going to turn a little bit to payments and remittance tech. Earlier this week, PayPal entered the Fortune 500, or I think it's the S&P 500. But you see kind of different areas that they're targeting. So we're going to just talk about some of the areas within PayPal's world, or just payments in general. This is Venmo. How many of you use Venmo? Right. So if you listen to it's a podcast that just talked about Venmo and the whole social aspect of payments. I forget what it's called, but really interesting growing area for PayPal. I think doesn't necessarily get as much attention as, or it's starting to get, I think, a bit more attention. So kind of an interesting area for what PayPal's doing. When you look at the kind of the the payment processors. Stripe's obviously kind of one of the darlings in this world, but if you look at Adyen, again, this is CB Insights Trends, it doesn't get nearly as much sort of press love and doesn't have sort of the Silicon Valley Y Combinator kind of lineage, but is processing massive amounts of transactions now. And what we see here is early stage activity remains strong into payments. So again, if you look at the deal trend here, kind of seed Series A deals continue to climb. So really healthy area. Money transfer just changing gears a little bit, really kind of doing well. Again, focus on the deal trend and less on the funding amount, because we think that's a better indicator of the health of the market. And this is kind of within the money transfer space. What you see here is, in relatively short order, TransferWise has made it onto the table, the league table. Obviously, Western Union, that is a massive institution, and so there's a long way to go. But you do see a venture-backed company there. When we look at sort of the payments processors, you got Visa investing in blockchain payment processing, MasterCard doing kind of mobile commerce, blockchain, sort of, again, common theme, and Amex doing payments, blockchain. Amex takes a bit more diverse stance, I think, on its payments. So they'll invest in things that maybe are a little bit more tied to their consumer brand as well. Insurance tech, Matt kind of covered some of this morning, but kind of it's this idea that insurance hasn't sort of kept up. Massive amounts of money that Matt alluded to earlier today. Big expectation shifts here when it comes to consumer expectations, the ability to buy insurance. And then there's really just an issue of product relevance, which we'll kind of dig into. So this is, nobody really loves their insurance company is what this tells you. Most of it is still happening kind of offline. And then you have individual life insurance policies are sort of declining in terms of, how many they are purchased. So, thinking about new products that should be in the insurance realm is becoming increasingly important. And so because of those factors, demographic, product, service shifts, funding into insurance, and given the massiveness of the market, we see lots of funding kind of flowing into this space. 3 of the 5 largest Fintech fundings of late have been in insurance. So, and Oscar, Mario will be here tomorrow talking about what Oscar's doing. So, some really interesting things happening in that space. Most of it's at the early stage. So when we talked earlier about experiments, there's lots of experiments happening right now. And so if you're an incumbent in the space, these are the companies to pay attention to. Again, not because they're going to all succeed, but because they're an indicator of maybe where the world is going. This is that landscape Matt showed you earlier. The corporates have really gotten active, and it's really, it's across the board. Life insurance, reinsurers, a lot of the Chinese-based insurers are getting active. So it's, it's auto, et cetera. There's really, across insurance, the level of interest is really, really widespread, and it's been very interesting to see. I think insurance gets, Daniel from Lemonade kind of did a pretty good job, I guess if I call it that, of kind of painting a picture of this very slow-moving, archaic industry. I have to give them credit for at least trying experimenting with investments and things. So we're seeing a lot of activity there, which has been good. Connected kind of IoT devices to help people with underwriting and actually claims prevention. So this is kind of an interesting idea now of not just making it about claims, but how do we actually make it so you don't need to file claims, right? How do we help you avoid that? So reinsurance, so this is, I think, Munich Re and Swiss Re getting involved. Lots going on there. So I'm going to close with kind of more speculative things that we're watching. I think I talked to somebody who actually, I saw some folks with their name badges had some of these, so that was cool to see. So chatbots, hitting finance, right? So this is on Trends. We did a search of chatbot and the word bank appearing together, or chatbot and the word finance appearing together. And so you see kind of a little bit of a step up there. And some of the articles kind of talking about this. So this is one of the trends that we think is going to be interesting from a customer support perspective or personal finance management perspective. We think there's going to be some interesting companies and things happening there. Kind of the next thing, peer-to-peer models in insurance. So Daniel at Lemonade's kind of a great example of this, but again, using trends, we can kind of go look at what's been happening in insurance when we look at insurance in P2P models. And so again, heightened interest in that area. It's still early days, so we'll see what happens there. But we think of it somewhat analogous to P2P lending, right? It sort of started off and didn't get maybe a ton of attention and then quickly sort of took off. This one I think is interesting because a lot of non-US investors are investing in US fintech startups, including a lot of sort of Asia-based corporations. So this sort of cross-border investment activity is one thing that we think is probably going to intensify when we look at Asia as a market, and it's a amalgamation of lots of smaller markets, obviously, but the level of aggressiveness in terms of wanting to access innovation and invest is really unlike anything that we've seen since we began the company. AI on institutional investing. So artificial intelligence is the buzziest of terms. I presented at the CEO, portfolio company CEOs were there. I think of one of our clients. I presented at their CEO summit, and my advice to them was, when you're doing your next round, just throw artificial intelligence somewhere in your pitch deck, because it's sort of that hot. It's sort of the new big data. So when you're, on the buzzword bingo scale, it's kind of off the charts right now. So, AI with regards to AI-driven hedge fund and institutional investing, another trend we're looking at. Underbanked, we're going to talk about this tomorrow. So I think folks are starting to maybe come around to this as being a opportunity that you can build real businesses in. I think 3-4 years ago when we talked about the underbanked with clients, they sort of nicely told us that, we think that's interesting, but it's probably more for the impact investors. It's not necessarily for us, because we care about profit. That's changing. So that's been interesting to see. It's just a market or a segment of the market that's not, obviously, hasn't gotten as much attention, but is massive. This is one that I kind of really like. So it's a little bit messy in trends. So what I did was just look at Amazon, Google, Samsung, or Apple, any one of them mentioned in an article along with mobile payments. And then I looked at Amex, Visa, MasterCard, and Citigroup along with mobile payments. And you see actually a lot more chatter amongst tech's sort of big boys in this area of mobile payments. And so it's sort of interesting. I think Dan Reed from American Family Ventures mentioned it earlier, and we're going to talk about it, I think, with Samsung and Microsoft tomorrow, is being a bit leery of working with big tech companies, right? And so I think that's an interesting dynamic. It's not, it's no longer just Citigroup versus Bank of America, but it's, you have Amazon and Google and all these unusual suspects entering. So I think it's an interesting trend that we're tracking in terms of their level of activity stepping up within fin services or fintech in general, and then within payments. Real estate sort of has become a big area of growth in sort of crowdfunding, kind of tracking, how is this going to kind of take shape? This is not WeWork, right? We're not talking about kind of space. We're talking about actually the funding of real estate. So we think this is a pretty interesting area that we're still early days tracking. Digital challenger banks, some chatter about this, but the actual idea of kind of online-only banks, how those are going to work and take off. So an area of interest that we're tracking. And this is kind of the final one around blockchain. So blockchain is very interesting, gets a lot of chatter, but then we tried to look at, okay, where is blockchain being talked about? So blockchain versus in insurance versus capital markets versus remittances versus compliance versus lending. And, you can see, without saying who's 1, 2, or 3, what you see is all of them are going up, right? So the interesting thing about blockchain is all these disparate applications of it and disparate industries that people are talking about deploying it in. And so we expect, and we've seen it in media and music and all sorts of other non-financial services areas that folks are talking about blockchain. So that was everything I had. If there's questions, I'm happy to take them. But thanks again for your time, and hope this was useful. Thank you.
There are a couple questions. Is fintech reaching a peak in hype, or is this just the beginning?
So I think you have to unpack fintech, because fintech covers a lot of ground, right? It's everything from marketplace lenders to robo advisors to insurance tech to drones for, property casualty assessment, right? So I think there's areas that are maybe more hyped, and then there's areas that are sort of very much in the discovery phase. So if you look at the blockchain example, that's more, I think, early days. If you look at marketplace lending, probably a little bit tougher slog right now, a bit more mature. So fintech's a sort of very broad category, and so within that, there's going to be things that are growing in interest and things that are declining. It's hard to say that overall the area is hyped. So.
We have time for one more question, but you talked about how corporates are dying by 1,000 cuts. What are some ways they can brace themselves or adapt to the changing landscape of fintech, and are there certain things that they've done that have worked particularly effectively?
Yeah, so I think when we look at it, there's an important part of the process is knowing. So kind of looking out and seeing what are the early stage companies, what's happening in news media, and sort of picking up on those signals early. And so I think there's a lot of insights that can be drawn from that. Ultimately, though, you have to do something, right? Like you have to put money behind it, some initiative, whether it's a company you want to invest in, whether it's some skunkworks that you want to build out, whether it's an acquisition. It's not, it's sort of maybe trite advice, but you actually have to do something, right? You can't just talk about innovation and put board decks together about we need to be worried about these companies. You actually have to invest and do something. So, but I think it does start with kind of understanding what your competitors are doing, understanding what business models are emerging, what areas are gaining interest, which ones are not. So I think it does start with that, but ultimately you have to put some money and some resources behind these initiatives. So, cool. All right, thanks everybody.